In 1991, one of Australia's most famous businessmen flew out of the country. His empire had collapsed, and his creditors wanted answers. The government, they wanted him back. And Australia became obsessed with one question. Was Christopher Skase too sick to return home to Australia? If you're new to the channel, hi, I'm Tristan, and this is Professor Punch. It's built by a team of entrepreneurs and legal professionals. For years, we've helped train staff and advisors around family offices and high net worth individuals. Today's story is about Christopher Skase, a media mogul, a resort developer, and a corporate showman. A man who built one of the loudest, shiniest, most aggressively confident business empires in 1980s Australia. And then he became the country's most famous fugitive businessman. But this won't be a cheap story about a villain living in a villa. That's too easy. The more useful story is how an empire that looked rich, powerful, and glamorous could become so legally fragile. Because Skase didn't just lose money. He became trapped inside the legal consequences of the structure he'd built. In the Eric Jury case study from the first video, the lesson was debt, guarantees, receivership, and control. This one's different. This is about what happens after the collapse, when creditors stop admiring the empire and start asking where the money went, when the founder's life becomes part of the legal file. That's the world Christopher Skase eventually entered. Not the world of parties, resorts, television licenses, media deals, and private jets. The other world: trustees, liquidators, charges, extradition fights, medical claims, and a decade-long chase across the world. The kind of chase that turned one businessman into a national obsession. This is business law education, not legal advice. We're using public reporting and historical accounts to extract general legal lessons for entrepreneurs. If you've got a real legal issue, speak to qualified counsel in the relevant jurisdiction. Now, let's get into the story. There was a period when the name Christopher Skase meant glamour, then it meant excess, then it meant collapse, and finally it meant evasion. By the 1990s, Australia didn't just see him as a failed businessman, it saw him as unfinished business. He was in Mallorca, Spain. Australia wanted him home to face questions and charges connected with the collapse of Quintex. Creditors wanted money. Investigators wanted records. Journalists wanted images, and the public wanted something simpler. They wanted the man who'd lived like a king to answer for his wreckage. That's what made the story so powerful. Skase wasn't hiding in some remote bunker. He had escaped to a Mediterranean island, a comfortable villa, and a lifestyle that looked much better than what his creditors were experiencing back home. When a bankrupt entrepreneur still appears comfortable, the public doesn't see complexity. It sees insult. To understand why Australia cared so much, you need to go back. Before the Mallorca escape, and before the extradition fight, before the headlines became comical and cruel. You need to understand how high Christopher Skase had climbed. Skase wasn't born in a garage startup myth. He came from a comfortable Melbourne background. He started as a stockbroker, moved into finance journalism, and then began playing the game from the other side of the page. He didn't just want to report on business, he wanted to be the story. In 1975, he established what became Quintex. At first, it wasn't the giant public image people later remembered. It was a financial and investment vehicle. Then it moved through retail, property, media, resorts, and entertainment. Step by step, Quintex became less like a company and more like a stage for Skase's ambition. The Australian business world at the time rewarded a certain type of operator. Confident, fast, connected, good with banks, good with headlines, good at making the next deal feel inevitable. Skase fit that world beautifully. It was all theatre, as they say, and in the 1980s, theatre mattered. Australia was opening up, credit was available, and the corporate raiders of the era made restraint feel old-fashioned. Skase's genius, at least at first, was packaging aspiration. He wasn't only buying assets, he was selling a picture of Australia as bigger, richer, more global, and more luxurious. A country that could have world-class resorts, media empires, and international entertainment deals. That image had power. The name that became inseparable from Skase was, ironically enough, Mirage. The Mirage resorts were luxury developments, statements, not just a brand, but a symbol. They told Australia that it too could be a playground for wealth, celebrities, and international attention. The Sheraton Mirage at Port Douglas opened in 1987. It was reported as a 100 million Australian dollar development built beside 4 Mile Beach in Port Douglas. At the time, Port Douglas was still transforming from a sleepy far north town into something much more polished. Skase didn't just build a resort, he changed the myth of the place. A great operator can change what an asset means. A piece of land becomes a destination. A resort becomes a status symbol. A media license becomes a national platform. The story around the asset becomes part of the asset itself. Skase understood that. The lagoons, the entrances, the service, the sense that guests were arriving somewhere important. The Mirage brand gave people the feeling that they were touching the future. A richer, more international Australia. And for a while, it worked. From the outside, it looked like the future had arrived early. But glamour is dangerous if it hides a shitty balance sheet. And the Mirage story already carried the seed of its later collapse. The assets were impressive, but expensive assets need financing. Interest has to be paid, security has to be respected, and covenants have to be watched. That's why luxury can be deceptive. The more luxurious the asset looks, the easier it is to assume the owner is safe. But the owner may simply be standing in front of the most beautiful liability in the world. Then Skase moved from resorts into media power. This was the move that made Quintex feel like something much larger. Quintex already had television interests, but the big leap was major national broadcaster, Channel 7. Instant national reach. The purchase in the late 1980s was reported at around 755 million Australian dollars. That deal changed the scale of Quintex. Now Skase wasn't only a resort developer with luxury assets. He was a media proprietor with access to one of the most powerful platforms in the country. That kind of acquisition is surely intoxicating. It doesn't just add revenue, it changes identity. One day, you're a successful operator. The next day, you're a national player. People return your calls differently. Banks see you differently. You may even start seeing yourself differently. Channel 7 gave Quintex reach, prestige, and strategic importance. It also gave the group more complexity. Media assets have their own unique regulatory issues. They have their own financing pressures, operating needs, and political attention. When you mix that with resorts, property, entertainment, and offshore ambitions, the empire becomes harder to read from the inside. That's the problem with conglomerates built at speed. They can look diversified, but sometimes they're not diversified at all. They're just connected. Different assets, same financing pressure, different headlines, same founder, different businesses. At first, the connections can seem powerful. The resort brand lifts the profile. The media assets add influence. The public company creates access, and the international deals create excitement. But when credit tightens, those same connections can become a transmission system for stress. Then came the move that made Skase look truly global. Quintex went after MGM UA, Hollywood, James Bond, the United Artists name, a film library, a chance for an Australian businessman to walk onto one of the world's biggest entertainment stages and show himself. In 1989, the proposed MGM transaction was reported in billion-dollar territory. One version of the deal involved Quintex acquiring major studio assets, with some assets to be sold back to Kirk Kerkorian, an American billionaire businessman and investor, best known as one of the major figures behind modern Las Vegas. Anyway, the message was simple. Skase was going to Hollywood. Think about how that must have felt. An Australian-based group built around resorts and television, now reaching for one of the great names in international film. For supporters, it looked visionary. For critics, it looked reckless. For the banks, it looked like another question. Where is the money coming from? The MGM deal did not land cleanly. Financing became a problem. The American subsidiary struggled. The plan that had made Skase look global started making the whole group look stretched. And once the market starts wondering whether a company can actually fund its ambitions, confidence can disappear very quickly. That's the cruelty of financial reputation. It takes years to build. Then one failed funding moment can change the room. Yesterday, lenders saw you as bold. Today, they see you as exposed. By 1989, the economic weather had shifted. Interest rates were high, credit was less forgiving. The big 1980s corporate structures started looking less brilliant and more burdened. A business built for sunshine was now being tested in rain. Quintex had heavy debts. The resorts needed capital. The media assets needed management. The US entertainment ambitions needed funding. And the market had started to ask whether the group was as solid as it had looked. That's when the glamorous story started becoming a creditor story. One of the first public cracks came through the US side. Quintex Entertainment filed for Chapter 11 bankruptcy protection in October 1989 after funding problems emerged. That mattered because it took the story out of press releases and into legal processes. Once that happens, language changes. The Australian Stock Exchange suspended Quintex stock trading after questions about the group's financial health were not answered in a way the market accepted. In November 1989, Quintex Australia went into receivership. Reported debts were enormous, more than 1.6 billion Australian dollars by some accounts, and higher in others depending on the entity and calculation. Whatever the exact number, the business had crossed the line from empire to enforcement. Before the collapse fully settled, Quintex had already been forced to sell major assets. The Mirage interests became part of the retreat. Reports from the period described a major sale of resort interests to Japanese investors for more than 433 million Australian dollars. The dream was being broken into pieces. Skase had built the Mirage brand as a statement. Now the statement had to be sold. When everything is connected, the strong assets may not protect the weak ones. They may be sacrificed for them. A beautiful asset inside a weak structure can become collateral, cash source, or a bargaining chip. The asset survives. The entrepreneur's control doesn't. The national TV assets were also caught in the wreckage. Skase had paid heavily to build media reach, but after the collapse, those assets were no longer symbols of rising power. They were pieces in a recovery process. The empire was no longer being expanded. It was being disassembled. One of the strangest and most revealing episodes involved the Quintex board. As the group came under pressure, Skase reportedly demanded that the board approve a 13.5 million Australian dollar payment to a private company he owned. The board refused to ratify it. Then it reportedly discovered the payment had already been made. When a company is calm, related party questions can look like accounting details. When a company is collapsing, they look very different. Skase also reportedly pushed for a pay rise and threatened to resign. The board resisted. Some directors threatened to resign themselves. One director reportedly took the issue to the Australian Securities Regulator. At that point, the crisis was no longer only financial. Quintex had been built around Skase. Skase had built Quintex around himself personally. By the time the Quintex story had become receivership, liquidation, and criminal investigation, Christopher Skase was no longer just the businessman behind a failed company. He was personally exposed. Skase faced allegations connected with improper use of his position and management fees. He was briefly arrested and spent a night in jail. He was later released and regained his passport. Then he left Australia. That decision changed his story forever. The public version is simple. He ran. The legal version is more complicated. There were charges, extradition attempts. In 1991, Skase filed for bankruptcy in Australia. His personal debts were reported at more than 170 million Australian dollars. Corporate debts were reported much higher. Skase's trustee, Max Donnelly, spent years trying to trace assets. Public reporting described efforts to find missing money, overseas accounts, furniture, antiques, and other wealth. Whether every allegation was fair is a separate question. The practical point is much simpler. The file didn't close when the plane left Australia. In 1991, a national newspaper found Skase on the Spanish island of Mallorca. That discovery turned a failed corporate collapse into a national drama. Australia had found the location of its fugitive. Skase argued that his health prevented him from returning to Australia. He claimed severe illness. Australian authorities, journalists, and much of the public were sceptical. Images of him with an oxygen mask or wheelchair became part of the media theatre. At times, the chase felt almost absurd. And yet, underneath the absurdity was a serious legal problem. Australia wanted him back. Spain, it had its own legal processes. Health claims mattered. Extradition rules mattered. Citizenship and passports mattered. The business collapse had become an international legal chessboard. Jurisdiction matters. Where you live also matters. Where assets sit, where companies are incorporated, where creditors can enforce, and where charges are brought. All those things matter. The phrase "chase for Skase" became part of Australian culture. It was serious, but also ridiculous. There were even jokes about bounty hunters and kidnapping schemes. A corporate collapse had become national theatre. At one point, television presenter Andrew Denton became associated with a public campaign to bring Skase back to Australia. The problem was the whole pattern. A fast-moving conglomerate, heavy debt, glamorous assets. The Mirage resorts were real. The television assets were real. And the media ambitions were also real. But real assets don't automatically mean a safe structure. An entrepreneur can own impressive things and still be exposed if the financing, governance, records, and creditor position are fragile. Skase's empire also shows how a business can become dependent on confidence. Confidence from banks, confidence from stakeholders, from counterparties, and from the market. When confidence is high, complexity is tolerated. But when confidence breaks, complexity becomes suspicious. That's why fast growth has to be matched with legal clarity. Christopher Skase was not a quiet operator in the background. He was the story. His lifestyle, his wife Pixie, private jet stories, the resorts, the parties, the deals, all of it merged into a public image. The private jet dress story became part of the legend. In the usual version of the private jet dress story, during the height of the Quintex glamour period, Skase sent his private jet between Australian cities just to pick up a dress for his wife for a party. It became one of those shorthand stories in Australia used to describe the Skase era. Private jets, resort parties, extreme spending, and the sense that the money would never stop. Whether you treat this story as precise history or corporate folklore, it captures the mood of the time perfectly. This was an empire that didn't just want to be rich, it wanted to be seen being rich. For Skase, the image he built during the boom would become evidence during the bust. Christopher Skase died in Mallorca, Spain in 2001. He was 52 years old. For years, Australians had questioned whether he was really as sick as he was claiming. Then he died of stomach cancer, and that ending complicated the jokes. It didn't erase the collapse, but it made the human story harder. By then, the chase had gone on for a decade. Millions had reportedly been spent trying to bring back Christopher Skase. Creditors still had unanswered questions. The public still had their resentment. And the man at the center of the story had become less a businessman than a symbol. That's the tragedy of these stories. So what actually broke? It wasn't the idea that Australia could build world-class resorts. It also wasn't the idea that a local media company could become more ambitious. It wasn't even the idea of going global. What broke was the structure needed to carry all of those ideas at the same time. The Mirage resorts had real value. Channel 7 had real value. And the MGM ambition and deal had a kind of logic to it. But value inside a weak, overextended structure can still become trapped. Today's entrepreneur can move even faster than in Christopher Skase's day. Stripe revenue, crypto wallets, offshore entities, platform income, contractors across countries, everything moving quickly, except the law. You don't need to become a lawyer. That's not the point. But you do need enough legal intelligence to understand what you're building. Because if you can't explain your own legal setup, someone else may eventually explain it for you. And they may not be so kind. The Skase story is a warning against unmanaged exposure. It's a warning against confusing glamour with strength. And it's a warning against believing that a big business, a public profile, and expensive assets mean the legal foundations are safe. Look at the pattern quietly sitting inside the story. Lifestyle is not liquidity. And governance matters most when you least feel like dealing with it. Most entrepreneurs don't have a legal structure problem because they're careless. They have a legal structure problem because nobody ever taught them what to look for. They were taught sales, marketing, product, hiring, content, fundraising, and growth. But they weren't taught how to see legal exposure. That's why the first step is not necessarily hiring yet another lawyer or legal advisor. The first step is learning to see your own business clearly enough to know what questions to ask. That's the beginning of legal intelligence. Skase's story is a warning. Making money is not enough. Looking rich isn't enough. And being famous is not enough. If the structure underneath the money can't survive pressure, then the whole story can turn very, very quickly. And if you're making $10,000 US a month or more, this already matters. That's the point where a lot of entrepreneurs start telling themselves three very dangerous things. 1, I'm not rich enough yet. 2, I'll clean it up later. And 3, my advisors will tell me when it matters. That's the trap. Because by the time it obviously matters, the weak points may already be baked in. So, take the Professor Punch Legal Risk Quiz. It takes less than 5 minutes. And it will show you how exposed your business and personal wealth is before the market, bank, partner, creditor, regulator, or one bad deal shows you the hard way. Click the link below in the description and get your result. If Skase's story made you uncomfortable, good. That discomfort is useful. It means you're starting to ask the questions serious owners ask before legal pressure hits. Make it, and then learn how to keep it.